Bringing across the bond market now, Jim Stening from FIG Securities joining me in the studio. And Jim, what a rocket up the leaderboard overnight for those US Treasuries. Another issuance, some appetite returning, but that means that yields have to fall.
Yeah, well, it's a bit of a surprise, the extent of the rally overnight. And in the scheme of things, we've seen a rally from 4% to 3.25% in a very short space of time. So, you know, I think the demand-supply equation is still heavily weighted on the supply side over time. I mean, obviously, you know, the weight of supply won't materialise in terms of higher yields until we're well into the issuance down the track. But this is a pretty remarkable rally, given it's in the face of that supply. I think what we're seeing is a little bit of a return to a flight to quality type strategy. Obviously, we've seen weakness in commodity markets, we've seen weakness in equity markets, and there are a few sort of shaky things starting to happen in the US domestic market as well.
And yet we've had, you know, in concert the IMF, we've had the World Bank coming out with a decidedly more bullish tone, if you can put it that way, than just a few months ago. So
yeah,
from their point of view.
That's right. I mean, you would expect, if the market believed that, and I'm not saying that they don't, but you would expect that in a recovery scenario that long-term yields wouldn't rally aggressively. So I think the market's at odds with that latest IMF report, and I think that is a result of the more recent activity in the markets.
What about, though, the fact everyone was saying, look, Alcoa is the lodestar, as it were, it's first off the block. It didn't disappoint as much as it might have overnight, and still, you know, the markets were what, getting up ahead of that and selling off?
Well, I think the key thing going forward to remember, I mean, we are going into the reporting season. A lot of companies, particularly in Australia, have taken steps to repair their balance sheet. But what we are going to see is we're going to see an incredible increase, or a steep increase, in defaults, and probably in the sub-investment grade region, but there will be some lower investment grade companies default. So that's sort of the, if you like, the noise that we have to live through, that will be very negative, I think, over these coming quarters. I think also one of the things that we'll be facing here domestically is our reporting season with not necessarily the listed companies, but when you look at a lot of small to medium type enterprises, I'm guessing there are going to be a few arguments between auditors and directors over that time space. So there will be some pain to be had, and it might trigger events for those companies.
Who will win the day on that front? When you say a bit of a tussle, auditors will be demanding what?
Well, I think you know, there's obviously you know, a significant degree of scrutiny that's required, and it will be applied. And in times of a downturn, that can obviously result in exposing certain things.
Can we move and look at sort of the returns to you know, to the year end now that we're into July? We can, I guess, reflect on what's built up there over that 12-month period. Where was the outperformance at? I mean, how do you look when you look at fixed income alongside other classes of assets? You know, where do we sit?
Well, interestingly, I mean, last year's a classic sort of, you know, tick in the box for fixed income allocation. You know, we've had a double-digit return on an index-based sort of benchmark. So I think it's close to 11%, the actual return there on the benchmark for the year in fixed income. Cash is around 5.5, 5.5, 6 for the year. Equities obviously in the mid-20s negative, and listed property well and truly below that.
So fixed income, I mean, what was behind that success?
Yeah, well what's happened, I think, obviously late in the year we had a fairly comprehensive credit rally, so that erased a lot of the losses over the year. We've also had you know, significant gains in duration, with short-term rates being duration bets with short-term rates being eased. So that's all added to the contributed to that return. Plus, obviously, the running yield. So you know, it speaks volumes for an allocation to fixed income, and it's really interesting because I think, you know, particularly at the moment, a lot of advisors and arguably people who should know better are sort of weighing the pros and cons of whether you should be in cash or whether you should be in equities. There seems to be this sort of jumping from one extreme to the other and completely disregarding fixed income as an asset class. And really, you know, I think that's symptomatic of the reason, you know, we're in this mess. I think that people should have more access to this asset class, and it needs to be considered.
Okay, but I mean, others, I guess the swing argument is that if you rip everything out of equities, then you do miss a tremendous buying opportunity at these levels. So you have to really
Yeah, well, look, it's a debatable point. I mean, is this a good time to buy? I mean, arguably, if growth is going to slow, as the 10-year bond yield is indicating, then allocation to growth assets doesn't make any sense at all. I mean, there's an argument for a core allocation to fixed income in that respect. So, yes, look, I mean, I won't argue that that equity assets are appealing in terms of the upside they can provide. But in terms of an asset allocation, it makes a hell of a lot of sense to balance a portfolio with a considerable fixed income allocation.
Let's look at iTrax, because when you say things are bobbing around left, right and centre, the latest print on this, we'll bring up the chart and then have a look and see. Just walk me through this latest shift.
Yeah, well, we're seeing, I mean, as I've said, you know, everything sort of lines up in terms of this rally in Treasuries. It's a bit extreme because I think there is short covering in the market. People have been short awaiting the supply, but it's, you know, it coincides with this sell-off in credit and a weakness in equity markets. So this is a bit of a retracement of the rally that we saw, that extreme rally. And realistically, I think it's, you know, we're going to see volatility around this 200 mark for months to come.
And in the midst of all of that, we hear NAB is buying back some bonds. And briefly, finally, on all of that, because it's again located in the financial space, are you reading an awful lot into that move by the NAB? I mean, does it have to go wider than simply a move by a financial product?
Well, I think so. I mean, well, I think it does. I think it is an indication, seeing them buying back this stock. It's not just the NAB. It seems to be, you know, there are other entities doing this. They're financials, as you say. But that is an indication, albeit small, of recovery. It means that they do have choices in terms of their capital. And so, yeah, it's an encouraging sign.
And the rationale behind it is what?
Well, it's, I mean, these type of Tier 1 hybrid issues offshore are trading at an incredibly wide margin compared to where they can be issued onshore. And also, by retiring that type of debt, then a capital or a profit can be taken to retained earnings. So, I mean, it's a capital management thing. It's also an arbitrage, and a large one at that.
And they've seen the window now as opportunity to do that, and I guess consolidate things back home rather than...
That's right.
Remain exposed to the volatility offshore. Thank you, Jim, for now. We will see you next week.
Thanks very much.
Right. Jim Stening there from FIG Securities.